Welcome to the Stonebridge video series. This is the Efficiency Drivers series on the balance sheet cash drivers. Hi, my name is Dan O'Connell. I'm with Stonebridge. Stonebridge sells businesses, consults businesses, and provides business valuations. As you recall, the income statement has three primary cash drivers: sales, cost of goods sold, and operating expenses. The balance sheet has four secondary cash drivers: AR, inventory, payables, and capital expenditures. These cash drivers generate and consume cash. All other items either don't impact business operations or are simply journal entries to transfer values. Let's begin with the AR days, and then the inventory days, and the payable days for the 4-year period shown. The cash conversion cycle is the number of days the company has invested its cash from the time of purchasing to collecting receivables. The formula is receivables plus inventory days less AP days. The smaller the cash cycle, the less cash the company needs to invest in the business. This is particularly important when the company is growing fast. The lowest AR days was 37 days in 2017. The lowest inventory days was 65 in the same year, and the highest payable days was 36 days in 2018. Payables are different in that the longer the AP days, the more a company is borrowing from their vendors. Some companies like to pay their bills fast, others don't, and appreciate the free loans that are extended to them from the vendors. In 2017, the company invested its cash for 72 days, and the next year it was 83 days. Let's apply the highlighted number across all years to determine how much extra cash has been invested in the business. Looking at the AR days in 2015, the company overinvested in receivables by 5 days. In 2018, they overinvested by 10 days. Then look at the inventory and payable lines for the same data. 0 means that the company had its best cash management for that account for that year. Now let's convert the days outstanding to dollar investments. In 2018, the 10 AR days translates to $246,000 of overinvestment when using the company's lowest AR days. In 2018, inventory days of 7 means the company overinvested $172,000 when compared to the lowest inventory days on hand. Payables extended the days on hand in 2018. That's why you see a 0 there. It was the best it had achieved in the 4 years. Its highest in the 4 years. In 2017, the lower AP days cost the company $52,600 of additional cash investment. The total investment in the cash cycle above the company's best ranged from $52,000 to $419,000. For those that want to figure out the extra cost, here are the formulas that we used. Now let's put together all the cash drivers and see how they impacted the company's total cash flow. From the primary cash drivers, we have the cost of goods sold, then the operating expenses, receivables, inventory, and payables. Totaled up, you often see numbers larger than you would believe. Here, the company's cash drain ranged from $162,000 to $1 million. Each one of these annual cash drains are significant. It's money that could have been used to reduce debt, invest in growing sales, or to be used for owner distributions. Let's look at the cash investment relative to the sales growth. Just by looking at these numbers, we can't really make any deductions. But we would have several questions to ask the company to see what's behind these numbers. Now let's talk about the last cash driver, capital investment. Capital expenditures are specific to industries and every company's fixed asset requirements. So here, let's just look and review CapEx rules of thumb. CapEx spending needs to be more than depreciation in order to grow. Sometimes we see companies that plan on growing fast, but the capital investment budget doesn't support the forecasted growth. For most companies, a CapEx to depreciation ratio of 1.2 to 1 is typical. So if your depreciation is around $83,000, CapEx should be around $100,000. Then companies need to figure out if CapEx is being paid out of cash or new loans and what the payback will be. Investments in fixed assets are no different from any other investment. There needs to be a return on the investment. Is CapEx spending for maintenance or is it for investment? Maintenance CapEx maintains the asset base, while investment CapEx grows revenues. Any deferred CapEx is a reduction in enterprise value. Sooner or later, someone needs to pay the price for the new investment. And finally, CapEx budgets are best planned over the long term for planning purposes. It's always good to see CapEx in the budget. To get to this point, we reviewed the efficiency drivers of the business. In the next video, we'll use what we have found here to forecast a hybrid financial statement, if you will, that looks at the core business functions going forward 5 years. This becomes the business plan of sorts. Thanks for viewing this video. Let us know, as always, if you have any questions. Thanks.